Hey, welcome to Protea Weekly. It is January 28th. I am in my hotel room recording this episode from Unified. It is that time of the year, right? We had the SVB report that I spoke about last week. I attended the State of the Industry this morning, which I got to really digest still and put a little bit of thought into it. I'm trying to get an article out for Friday. You can find that on my LinkedIn page. Maybe I only do that next week. But I wanted to take a few moments just to talk about, what's going on in the M&A world. I was able to attend a session called Love It or Listed Wine Edition, and it really went into the space of what is happening when it comes to M&A. And two of the big speakers, people that I've got relationships with, Cody Jenkins of BMO, as well as Pat DeLong of Azure, and they just spoke about what they're seeing in the market. And it really is just an interesting as we try and take in what is going on, right? One of the big takeaways from both the SVB report and the wine industry, state of the state of the industry report this morning was, hey, we might be seeing where the bottom is. And maybe even if we don't know what the bottom is, we have sort of got to a point where we think we've figured out supply. And that's been hard work, right? Growers have really bared, you know, the overwhelming majority of that just depressing attack on having to pull vines out. We had too many, both in the US and globally. A lot of that's pulled out, which has automatically fixed some of the supply issues. It looks like we're going to have a very, very light harvest. We're talking numbers that we haven't seen since the early 2000s, which will help fix some of the inventory bubble that has just been sitting around. Not all, and we probably need another light vintage in 2026, but we're heading in the right direction. But this then puts a lot of pressure on what is the M&A space. And if you are a winery owner and you are looking to sell, the message was very clear. Only do it if you have to. It is rough out there. A lot of the buyers are risk adverse. And if they're going to buy your property or if they're going to buy your brand, they are looking for ways to reduce that risk. Because remember, interest rates are high comparative to what we've been having before this, in the 3% or now in the 6%. So cost of capital is more expensive, which means when an investor is looking at a purchase, changes the way they look at things, because it can definitely push their return to a lower number or way further out than they potentially want to be in it. So what they're saying is, if you're going to sell, you're going to have to be creative in burdening yourself with some of the risk, which generally translates to either a lower price or doing things to make it easier on the buyer, like having longer payouts, a lot of incentives on top of some sort of base, or in a lot of cases for winery owners, maybe having to stick around for longer than you expect because you have invested interest in that operation doing well, and you need to be there to assist and to make sure it goes in the right direction. A couple of the key points that really were pointed out during these sessions was, the funnel is shrinking. And that's because people are seeing there's just less points of distribution. On premises down, off premises down, and that means less people want to invest here. It just is a little scary, right? It's the whole access to consumers getting narrow, which means the opportunities to grow something are just a little bit harder. So if the funnel is tightening and that they don't feel like this is cyclical, this might be a bit of a longer term issue with ag in general, you have to be a lot smaller. It creates this world where there's just really two different types of businesses you've taken on. It's the large wholesale producers fighting for fewer placements and the smaller producers now having to fight for DTC. And the problem is those DTC brands aren't quite as attractive, because if you're so heavily DTC and you're selling to 100 people, what is the opportunity to make that 200 people, right? It's very different when you're in wholesale. Like, I've got 5 placements, let's grow it to 10 placements, which could take it from 1,000 cases to 2,000 cases. So SVB reports say this, the panel said this as well. DTC is a great opportunity, but it might not be a growth strategy to make you attractive for an exit. If you are DTC dependent, the panel generally said it is harder to finance, harder to value, and harder to exit, unless you can prove retention, lifetime value, and scalable demand. Those are all hard to adjust for, right? It's hard for people to prove those numbers. Great, you have a great list. They've got a lot of good lifetime value. They've been around for a while. But again, how do you scale it? If you've only been able to get it to 100, how do I get it to 200? What can I magically do to grow this number? So be cautious of that. I'm not a big fan of wholesale, especially for small family brands, but understand that it just does limit your market to sell your winery in the future. They then touched on capital. Capital hasn't left. It's just repricing the risk. I sort of spoke about that a little bit more. We're just in a strange place. Ag is just not as attractive. That includes wineries. Alcohol beverage in general is just a tough place to be right now because the facts are there. People are drinking less, so the market is smaller. And how does wine continue to grab that market? That's a question that we're all trying to figure out. The ones you have figured out are thriving. The others are struggling along. And investors are looking for a little bit more of a sure thing, right? Like they don't want to just bet that something works out. Now, if they're bringing in the property, they can take some more opportunities. But again, that's a long-term play. So you're looking for a very specific investor. Again, it comes down to just how do we structure these deals, what you're willing to do, how much of the risk you bet, willing to burden. One of the other things that sort of made a lot of sense was the talk around strategic buyers. Historically, you have a good brand, you go to some of the big players, they'll play around with it, take a swing at your brand. Let's see if it works. Hey, yeah, we've got 3 shard brands already. We'll do one more. Who big cares? That's not happening anymore. If anything, the big strategic players are sort of doing some sanitization and cleaning up their portfolios, getting rid of the duplicates. And where they're only really making moves is if they can make a buy that will give them market share they are struggling to get into. So if you've got, a brand that Gen Z are loving and just buying a ton of it, strategic players might be interested in that because they're struggling to get into that space. Or if you've got, a really cool varietal that people seem to be, hovering to, they might want to do that. Or if you've got a really great, production facility or access to grapes that they haven't been able to get into, that becomes an attractive portion of the market. Strategic players are not just shopping for fun anymore. They're shopping with real thought behind it. And it just creates a different market. Now you have to look at different buyers. You have to look at speculative buyers. You need to look at international buyers. That they did point out international a little scared of US. Like at the moment, it's not as attractive to invest here. I think those will come back, and there's probably going to be the cases where some people don't want to do it, but there is economic uncertainty, there is political uncertainty, and it is a little bit scary. The buyer is just different, and the strategic buyers are just not there as they used to be. So you're going to have to be something really special where they can't get into to be able to unlock a strategic buyer, which just means there's different conversations, and you have to work professionals to find those buyers for yourself. Land is still a long-term asset. That is very clear, but people can be picky. There's a lot of properties on the market that a lot of people looking to get out. It's horrible to say, but premium regions still matter. Napa proper is just going to do better. It's just a fact. You can be in a good AVA, but if you're on the outskirts of that AVA, it's going to be hard. You might be in the Napa AVA, but it's the sub AVA that people aren't that interested in. You could struggle. Mendocino, Lake County, Lodi. It's hard, right? If all that property is good for is for grapes, you might struggle to find a buyer. If there's an alternative crop or could be for some other project, hey, that becomes interesting. But those outliers on these regions, that's where hard decisions are being made. That's where vines are getting pulled up. That's where, what do we do? Let's go into a different business. But it becomes even more important that you just look at what you've got and how do you value it. And what it pointed out is that core assets need, quality. They need some sort of premium, like description feel behind them. So make sure you've got good quality soil. Make sure your grapes are being farmed in the best possible way. Sustainability is expected. Look at some of the other options around that to even improve your farming procedures that could in the long term reduce your overall costs. And having reliable grape contracts in place makes you very attractive. It does come with a warning. Make sure that the contracts you have in place are transferable. Because a lot of contracts can be like, if you sell, I can cancel my contract. So if you're thinking long-term about selling, put contracts in place where you have the flexibility to move and that buyer doesn't run away. You just have to think a little bit differently. The market's different. There's a lot of fruit available at this point. It is not going to be easy to buy and find another buyer. So do things today that will help you 2, 3, 4, 5 years down the line. The way people are valuing business is so very different in the current market as well. And I think one of the things that you need to understand is that the days of big multiples are gone. We're not just buying shiny objects anymore. People are interested in real, sound businesses. And it sounds crazy that I have to bring this up, but I think for a long time, a lot of winery owners have just got away with riding the wave. And I think it's critically important that we take a step back, be disciplined, be focused, really put in the effort on what you're good at, understand who you are and what you want to be. And that is critical in creating a good, sound business. If you're a business that has good practices, understands who you are, has good values, has the vision set out, and you're working towards it with solid goals and a strong team in place, that is value. That's what people are willing to buy. They want to buy a business that operates. They don't want to buy a winery that just makes good wine. And that's tough because we all now have to think about our businesses as businesses and not just projects. It's a mindset shift. And this is where getting good professionals in place can really help you. Get a good team, get a good accountant, get a good tax provider, get a good attorney. When you want to go sell, bring in the professionals, bring in those M&A firms that can help you get ready, talk to the right buyers in the right terms, and set you up for success. So what do you do right now? You're a winery owner, you're thinking you want to exit maybe right now, maybe in the future. What do you do? The short answer is start preparing. There was an M&A guy that I spoke to, non-wine space guy, and he always said, when you start preparing for exit is the day you start. So on first day of business, you should already be thinking, at some point I want to exit. What do I do today to set myself up for success then? And I know a lot of us don't think that way. I didn't think that way when I started my business. I just sort of got on with it. But you have to put processes in place, discipline in place, and set yourself up. Where am I going to go? If you want to sell, recapitalize, simply survive, you need to understand what your business is worth, what the risks the buyers are seeing, and how can you eliminate them, and what can you fix right now? What can you do? You get into the real nitty-gritty. There's like the opportunity to decouple assets. You can do sale leasebacks. You can right size. There's a lot of things you can do. But I would say good business practice says start preparing for exit sooner than later. Because we're all exiting our business one way or the other. That's either through going out of business, that is either through selling our business or exiting this life. So we might as well get ready for it. That starts with discipline, that starts with understanding who we are and then understanding where we want to go. One of the big points that they did put out, like not every business is going to sell. 100% more businesses are going to be wound down than sold in this industry. And for a lot of people, winding it down, there's more value than trying to sell it. There's costs involved in selling. But try and focus in on doing things right today. Make sure you have a good facility to produce. Make sure you have the right grapes that you want to be able to produce. Make sure that you're listening to your customer, building loyalty with them. If you want to go into distribution, find 1, 2, 3 markets that you want to spend time in. Build those markets up. Spend time in those markets. Talk to the distributors in that space. Make sure you have water rights all secured. Make sure that your licensing is all in place. Make sure you're compliant from liquor laws, labor laws, taxes. That's all in place. Make sure your contracts are documented. Make sure just have everything in place. I always say get a good accountant. Protea can help you. Get a good team in place. Make sure everything's buttoned up and run a business. We get into because we love wine, but it is a business at the end of the day, and we need to set ourselves up. The message is really clear. This is not a cycle. This is an adjustment to a new norm, and that norm is down. A lot of people are saying the bottom is near. It's going to be a rocky bottom, but it's near. If you want to survive, I've said this before, it's time to get disciplined. It's time to get focused. Discipline, focus, fundamentals. Work on those, and you've got a chance. Until next week.